Hello everyone, welcome to a new episode of Investing Fool. The turmoil in the markets has continued, so February has not been a good month either after the mayhem that we saw in January. And what a start it has been to the year 2025. Most portfolios, like most investors, are seeing reds on a daily basis. Stocks are tumbling down, and most portfolios would have also seen their max drawdowns in some while, right? At least in the last 3-4 years, we had not experienced a drawdown like this. So in general, not a very good time or not a very happy time for market investors. But if you think in terms of strategy or in terms of actions, they remain the same. So we will continue doing what we have always been doing, and if you have been associated with this channel for long, then you would know what that would be. We would rebalance the videos, rebalance the portfolios. So on Monday, right, we will rebalance the core portfolio as well as the Nifty top 10 portfolio. We'll discuss that in a separate video. I'll upload that video sometime next week on the rebalancing bit. And when I say rebalancing, also, as I discussed in the last video, we won't be like discussing specific stocks or the portfolio performance or anything like that as per the guidelines, as per the revised guidelines. But you can check, like if you want to check, you can check our portfolio files. They are in the channel, and they can be found in the video descriptions as well, which will give you all kinds of details on which stocks we are buying, when we are buying, how much we are buying, when we are exiting, why we are exiting, stuff like that, right? So keeping that out of the way, this video is not about rebalancing. This is just a general video. I felt that the kind of capitulation that we saw on yesterday, right, the kind of sell-off, I thought that I'd put out a video just about my general thoughts on the market, and then what I'm doing, the behavioral part of it. So let's discuss that over the video. Please go through the disclaimer. It's very important. Consult your financial advisor before making any investments. Whatever we are discussing here is just for educational purpose only. Okay, so let's get started. So is this the capitulation? So typically when markets tend to bottom out, it's when the last positive standing investors, the last investors who still have a positive or a bullish view, they kind of throw in their towel ki boss ab bahut ho gaya, right, we are getting out, we are liquidating our positions, and the large chunk of investors, like the overall sentiment, the sentiment now also is bearish. We are overstressed, we were overstressed on the positive side as one extreme. Now we may be to some extent be overstressed on the negative side as well, right? But when that will stop, obviously no one knows. But typically when we approach the bottom, a final kind of capitulation happens when a lot of sell-off is triggered in a very short amount of time, right? So is this that phase? To keep the answer short, I personally do not believe that this is the stage. Maybe some more pain is in order, but as I said in the last video, we would be close. That is again a personal belief. I'm not a market forecaster. Like, no one forecasts the market with accuracy, but we would be. I would assume we would be close to the bottom, right? And when we talk about bottom, just know that we are talking about the lowest point. We are not talking about the recovery. The recovery can take months, years, whatever, right? We are not talking about that here. Just talking about the bottom. Okay, so a few factors that about the market in general. So you can see the Nifty 500 chart here, by the way, on the right hand side. It's over 1 year, we are just where we were 1 year back, right? So not much of gain has happened. So anyone who had invested in the last 1 year, specifically in the last like 6 months, 3 months, if you have come in with a lot of capital, you would be sitting on massive losses now. That is a part of the market. We have shown in previous analysis as well that someone who would have invested at the top of 2008, right before the fall, they would also have made quite a bit of money if like they continue to follow the strategy for the long term. So that will remain the guiding principle, the North Star for us. But yeah, let's discuss some factors. So when we were seeing these valuations and markets get stretched last year, right, a familiar thing that everyone was kind of speaking about is that valuations are stretched. right? And when the market started like correcting, the reasons were these, right? That valuations were stretched, earnings is not coming, growth is not happening, so these cannot stand, they have to fall. And a large part of that is now done. So valuations have corrected quite a bit, they have come off quite a bit. Some of the large caps may not have come off that much, but there is certainly a lot of pain in mid and small caps. uh, Even now some pockets would be definitely would be much more expensive, but they're relatively less expensive than they were some time ago, right? So overall I think valuations, the level of discomfort that people had with valuations, of course as momentum investors we do not rely on valuations or whatever um, to initiate our entries, but for the people they do, that the level of discomfort that like a valuation expert or a fundamental investor might be feeling a few months ago, they would now, that would be much reduced now. They would be much more comfortable deploying into the stocks they like in a staggered way, because we do not know how long this can go on, right? But at least the fully like I mean, the full view that valuations are so stretched that I'm not going to put anything in, right? Or that I'll remain largely 80%, 90% in cash or whatever. That kind of a reason doesn't stand anymore. So, but while the valuations and earnings have that factor may have eroded a little bit, there are new factors that have come in now, right? So first among them is the tariffs by Mr. Trump, who is continuing to threaten all the countries on the planet that the US is going to put a bunch of tariffs on every kind of trade. So what implications that will have, that is one factor. Another factor is the US market. So US markets were going pretty beautifully while the emerging markets were suffering, and now the US markets have started tumbling down a little bit. So what impact would that have on emerging economies, including India? So there are a couple of new risks, new factors that are emerging. These are unknowns, right? They will play out over a few months. What happens is that whenever like markets are in kind of a overall bullish sentiment, so whenever something small like positive also comes up, the markets tend to discount a lot of positivity in a very small time, and that's when we get the pendulum gets overstretched in one direction. Now when a new risk comes, and it is unknown, right? The market doesn't know what to make of it, so a lot of negativity may also get squeezed in a very small time. So the pendulum then stretches in the other extreme, right? So that some part of that is playing out now, but the overall point is that if your point was that the only issue was with valuations and earnings, that point has been addressed to some extent, but now there are new factors to consider. So while we may not fall because valuations are not like where they're supposed to be, we may fall because we may continue to fall because of other reasons, other global factors, right? Okay, so in terms of the overall dynamics of the market, you will get a lot of data points. Like we have gone now 5 months, 4 months in red, and this has never happened for 2 decades or whatever. And because that has happened, now it is more likely that we are like we may have some short bounce or recovery, right? And there are a lot of data points, there are a lot of observations. No one knows where the market is going, but for us the core portfolio is at the maximum drawdown right now. So the current drawdown is the maximum drawdown that we have ever seen, and anyone who would have invested any time after COVID, I personally got introduced to momentum only after COVID, right? So for those of us who have started investing, not investing in general, but investing in momentum at least after COVID, they would likely be sitting at their maximum drawdown as of now, right? And the returns at the portfolio level also are pretty abysmal at this point. We are almost to the point where we may go in negative. So now we were just losing the returns that we had earned in the last 1 year, more than 1 year, right? Now we are getting to that territory when some portfolio will start going to the capital erosion territory, right? So the capital itself will start, I mean, the overall portfolio will go will fall down from where it was in terms of the initial capital that is invested. Okay, so we can go obviously anywhere from here, and I came across an interesting article by Capital Mind here. I'll share a link of it in the video description as well, so you can go through these articles, and a lot of interesting data points here, that like whenever the median stocks decline exceeds 40%, the probability of a further decline likely increases, right? So we are currently at 43%, so we can go either way. Even third point that you see here is that there is a wide range of outcomes possible, right, from here. So you can go either way. You do not know, like, although it may feel good to us that we have fallen so much and we probably cannot fall any further, right? Typically corrections, we would see some recovery. There can be a quick recovery as well. There can be further pain as well. We just do not know. However, like, we do not, like, I personally do not see, I am not an economist, but I personally do not see any risks of that level which would trigger a very like wide like pain or anything of that sort, right? The context of what had happened in 2008 was very different. The context of what had happened in 2020 was also very different. These were big global black swan events, and whether we are in that same territory, whether the risk level is so high, I personally do not think so, but the markets and time only will tell where we are going to go. One final point is that I heard this view somewhere that correction in large caps may need to accelerate for a final capitulation. So right now, that's what I meant, right? When I said the last investors who are there, who are still bullish, who are still holding out, when they start going short and they start dumping their stocks, that is when the capitulation will occur, and this point hasn't come yet now. So some quick, very brutal pain might be in order some time in the future. Okay, now about the recovery, right? People are talking about V-shaped recovery, U-shaped recovery, L, K, whatever shaped recovery you can try to make, but most people feel that because the earnings also, the improvement in earnings will happen, right? From Q3 and from next financial year, it would happen, reasonably happen, but the improvement would not be so great that you would just remove all this pain very quickly. So it likely would not be a V-shaped recovery. It might extend for some more time, so some time correction may be in due, and if we consolidate for a few months, then that would lead to higher drawdown days, right? So the drawdown days metric also, that I haven't added on the sheet actually. That reminds me, I would add the drawdown days metric on the sheet as well. Basically, from the top to the bottom, how many days you spent, right? And this can stretch for years. This definitely can stretch for years, so be very mindful of that. Okay. One very important point is all this that we are talking about, right? कि क्या हो रहा है, क्या हो सकता है, क्या होगा. Like, all these are market views, these are opinions, these are conjectures based on historical data, right? But this does not necessarily have to translate to action. Your market view, my market view may be कि कल market गिर जाएगा, right? But I would still stick to my strategy like a robot. You have to stick to your strategy just like a robot, right? Just imagine that it's not a human at the top making decisions. It's an algorithm, it's a robot. It doesn't care at all whether it's a bull market, whether it's a correction in a bull market, whether it's a bear phase in a bull market, whether it is a bear market, whether it is outright Great Depression. It doesn't care, right? All the backtests and everything that we see, we kind of assume that, okay, we'll follow the same thing for 20 years and what will happen. But while actually following it, we try to second guess it always. That so if we take the second guessing part out of it, just think like a robot, so nothing will change. So market view is not equal to action. My market view may be anything, but my action will be as per the strategy only. Okay. One final note on this is I recently changed something, and this portfolio is not public as of now. It's the all caps portfolio. I'm personally not invested in this portfolio. As I always say, I'm personally not invested in the Nifty Top 10 portfolio. I'm personally not invested in the all caps portfolio. I am personally invested in the core momentum portfolio, which is based on Nifty 500. And anyway, so I rebalanced the all caps portfolio, and almost like 40% of the stocks got exited. And I just realized that I started this portfolio in November of 2024, right? So 1 year from where we had started the original OG, this core portfolio in November of 2023. We started at the end of November of 2023, actually. We started from November 2024 on the all caps portfolio, and it couldn't be a worse time probably to start the to start a momentum portfolio. So this will in future, as we go on, as like some months go, some years go, when we are in a different reality, right, this will be a very good case study for what happens if someone starts a momentum portfolio at the peak, or at the worst time, right? So we will keep revisiting that portfolio sometime, as to what happens with that portfolio over years, right? If I had to start at like a really bad time, then what would happen? If I just follow the strategy again like a robot, no change there. Okay, so this is about the market. Then we come to the second part, which is what we are doing. Most of you who have been with this channel for a long time would know what we would be doing, which is to remain consistent. But there are a few things I want to talk about here also. So the current scenario is kind of baptism by fire, and we like these are the things that we dread, right? As investors, if you have never been in a drawdown, you will get viewpoints like, okay, you have never seen a drawdown, right? This is only the good phase. You are making money during the good phase and all, right? So when you are in a drawdown, it is unpleasant. It's definitely unpleasant. It's very painful, but it is also exciting to finally face what you were always fearing, right? You were always fearing this, that okay, I haven't seen drawdown, I don't know how my strategy will perform in a drawdown, I don't know how I'll recover from a drawdown. So this gives you the chance to actually test all those demons that you had in your head, right? All those fears that you had in your head, they are materializing right now. Right now you are in that space where you are seeing massive drawdowns, massive pain. Your behavior, your actions at this point will define like whether you follow with the strategy in the future, how much conviction you develop in the strategy in the future, all those things, right? Everything. So this is a very exciting time from that perspective, from if I have to employ that perspective, and that will also only become apparent in the future. It will not feel like that. For now it will feel like, oh hell, what the hell is happening in the market, right? It's completely going bonkers. Everyone is in pain. No one wants to get into any new stocks at all. But when you look back on this time, like maybe from a few years from now, you would realize that this was a pretty good time to from a learning perspective, from a conviction perspective, from an action perspective. Okay, so as I discussed, no change in strategy or asset allocation for now, and I'm not saying from a point of arrogance or anything that the strategy cannot change. Obviously the strategy will change. You will, maybe you will get some new information over the years, you will tweak your strategies in certain way, but the essential point is that strategy, when you think about setting up some strategies, that right, you are thinking about the long term. So these are meant to work reasonably well over the long term, right? But if some correction is making you doubt your strategy, that's fair. But if that is the case, then you do not rethink the strategy, you rethink your risk appetite, you rethink your asset allocation. Okay, if your strategy was for the long term, you had backtested it for 20 years data, 50 years data, whatever, right? You come back and you start doing it, but then you come in a phase of the market in which like it's all pain, it's all doom and gloom, right? The problem then is not with the strategy per se. The problem may be with how much you are allocated to the strategy, right? So always like whenever you are getting like second thoughts in your mind about following a strategy and all, if that is happening quite often, then the problem may be lying in your risk appetite assessment and in your asset allocation. So keep spare some thought for that during these times. If this fall continues, if we continue like this, then very few stocks will eventually qualify. There are now less than 40 stocks, right? So our worst rank held is 50, but less than 40 stocks are qualifying to be ranked for the strategy. So that is where we currently are. But if this fall continues, most stocks will be down by more than 25% from their all-time high, and essentially if that happens, no stock will qualify to be in the strategy, and the strategy will go fully to cash. If some stocks do not qualify, like let's say we have only 15 stocks that qualify, right? So the money that will come from the remaining 5 exits in a 20 stock portfolio, that will go to cash. So the portfolio may move partially to cash if this kind of a fall continues. And in fact, the nifty top 10 this time, I had posted about this yesterday also. Nifty top 10, there are only 8 stocks that are qualifying at the end of February. So it was meant to be a top 10 portfolio, but now it will become an 8 strong portfolio. The money that will be coming from 2 exits, that will not be taking entry into any new stock, right? So the portfolio will remain partly in cash until the next rebalancing, at which point we will assess again. Okay, this is, I mean, important, but it's a personal point. It's a viewpoint, it's an opinion. I feel at this point, I feel a very, 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 very strong conviction to not remain in cash. Like I know that like we can fall 10%, 20% or whatever. Like होने को तो कुछ भी हो सकता है, right? We may fall another 10, 15%, whatever from here, and it is point, but that's a valid point. But the kind of pain that we have seen, we have already seen, and valuations have corrected quite a bit. At this point, I do not want to be in cash and away from the market. I want to remain invested. If I'm so at this point, what am I ensuring? Basically, I'm ensuring that I'm remaining invested in the stocks that have seen a lesser degree of damage, right? Whenever the recovery comes, I'm not saying like no one knows when the recovery comes, but whenever the recovery comes, I want to be in stocks. I do not want to be in cash, right? So that's the essential point that I want to share. And again, as I said, right, if we look at momentum indices or regular broad market indices also, they don't go to cash, right? The Nifty 200 momentum 30, Nifty 500 momentum 50, they're not going to cash. They're taking the pain chin on, right? So and there would be very good data points to suggest there are multiple strategies which like are able to sort of time this very well, or use other indicators. Some of those may be lagging indicators to go into cash. So the pros and cons of both this are different, right? But in general, the way I am seeing it, right, when we look at most backtests, when we look at indices, they do not go in cash. We look at those numbers that okay, this has returned like 20% or whatever over the last 15 years in a backtest. But when implementing it, we again start having second thoughts about cash and all. So we being like currently being, I'll show you on the strategy page as well. So right now I because of what we had discussed in the last video, we won't be showing a lot of pages or tabs from this sheet on the video, but some of the tabs we can show, right? Like general tabs, like for example this here, you can see on a 6-month basis, none of the sectoral indices are in positive territory. On a 1-year basis also, like most of them are in negative territory, so that's really not a good thing. But I was showing the strategy tab. So if you go and check out the strategy tab, so this is a step that we used to have earlier, right? And based on Nifty 500 and the portfolio equity curve, if both of them are below their 200-day moving average, we didn't take any new entries, right? So that was the way. Currently we have moved to a pure play rotational momentum strategy, which means that as long as we are getting stock opportunities, as long as we have stocks that are qualifying to be ranked as per the thresholds that we have set, we would not go to cash. Okay, so this dotted region that you see here is kind of an optional step. So for now I'm not following this. So we had followed this once in November actually. And we will do a very comprehensive assessment whenever we make a new all-time high, maybe months, years from now, that how this portfolio would have performed if I had gone to cash like in January, at the end of January or something. And because then we would have both the comparison points. Currently we have only one comparison point of how much the fall would have been mitigated, right? We would also need to see the recovery, right? How the recovery happens if someone is in cash and they're waiting कि 200 DMA के ऊपर कब आएगा, right? And then their whipsaws and everything. So we will account for that entire thing when we do that study. For now, I just wanted to illustrate the fact that this optional step I'm not doing so kind of a 200 DMA based going to cash call or stopping entries call. I'm not doing that of now. I'm just following the rest of the strategy, and you can see that over on this sheet. Coming back to here, so rebalancing, right? So rebalancing is very important. This I discussed in the last video as well. It might feel stupid, not stupid, but it might feel pointless, right, to get into new stocks, because again those new stocks will again fall. What's the point, right? What's the point, anyone would say. One approach that sometimes works in these kind of falls, although again there you can never time the bottom, right? So the market can recover anytime, but one thing that could help to some extent was to, like, for every rebalancing you can probably deploy half the amount or whatever proportion of the amount you want, and keep monitoring, right? If it falls further, maybe you can like average down also, although I don't know how much averaging down would help in these kind of scenarios when it's a consistent secular fall, right? Every day we are falling. There is no bounce that is coming, but we may be very near, we don't know. So everything has a pro and a con, so please be very cognizant of that, but rebalancing definitely we should be doing, right? We need to continuously reevaluate the situation, the market situation, and we are continuously getting into less damaged stocks, especially concerning rebalancing. Exits are very important, right? Look at some of the stocks that were in our portfolio last year. We exited with gains, but see where those stocks are now, right? So like exits are very crucial at this like these times, and rebalancing also as a whole. Just continue following the strategy, and you will, if you are in a pure play rotational strategy, you will be allocating yourself to stocks that have seen less damage, right? And whenever the recovery happens, because you are anyway continuously rebalancing, right? If during the recovery these stocks do not run up, right, something else runs up, so that will come in the screener. You will get into those kind of stocks, right? So yeah, so that's one point. We'll realize the bottom only in hindsight. In terms of my strategy, asset allocation, the other things that, like for example, I invest some proportion to momentum ETFs also, the passive indices that we have, right? Momentum 150, mid cap 150, momentum 50, then NSE 500 momentum 50, NSE 200 momentum 30, these indices, whatever I would have done in a regular time, I have been doing now also. This is probably a very good time, because these indices are below, like much below their 200 DMA. So this is probably a good time to put money in a staggered way, of course, because they can fall much higher also, right? In 2008, something like a Nifty 200 momentum 30 would have fallen like 70-75%. So that's another thing that I'm continuing to do. As I had shared, not buying a lot of gold as of now. We will see where gold prices stand in the next few weeks and months. And one final point I want to leave you with, and this is related to the first point, the baptism by fire point, is that this is probably the best time for all of you who have like gotten into high beta strategies or whatever strategies you are using, right? Because it's falling for everyone. So this is the best possible time for you to test your theories about how to behave in a bear market, because it's very easy to be in a like secular bull market and say, okay, if something like this happens, I'll handle it this way, I'll handle it that way, and all. So now is the time to handle it, right? Now is the time to explore, experiment your stuff, right? If you're not sure about the strategy, then what like change would you do, right? How would you tweak something, right? If you're confident about your strategy and you're still seeing losses, then having the discipline to continue doing those actions, right, and to build conviction. Because once you have seen something like this, right, this is probably the biggest drawdowns that a lot of investors have seen, including me, in terms of a momentum investor. This is the like the worst kind of a drawdown that I have seen in a long time. This, once you are through with this, and definitely you will be through with this, right, sometimes the market will recover. Markets have always recovered in the past hundreds of years. They have recovered. That is not going to be proven false, right? But whenever that happens, this time, the your actions at this point will lead to a lot of conviction in continuing to follow the strategy in the good times, when the good times will come, right? And of course, we being bullish overall, and continuing to remain invested, we will be just preparing for the next rally whenever it comes. We don't know when it will comes, but we are hopeful. Hopefully March won't be that bad. So that's all really that I had to discuss today. If you liked the video, then please press the like button, and if you haven't subscribed to the channel yet, and if you like the content, then subscribe to the channel. Unfortunately, like, we are not showing a lot of the stocks and stuff on the portfolio sheet anymore, and that is going to remain as it is. But yeah, good to gather some thoughts, and let us know what you are doing, what strategies you are employing to lessen the pain, to mitigate the pain, whether you are continuing with your strategy in full spirit, right? Do let us know, and I'll see you in the next video about the rebalancing sometime in the next week. Till then, take care, enjoy your weekend, bye bye.